Ever wondered what it really takes to own a hotel? It is a fascinating mix of real estate and daily operations. First, you face massive upfront capital expenditure. Buying land, building the property, and designing the rooms require significant initial financing. This makes hotels a heavy real estate play. You are investing in a physical asset that hopefully appreciates over time. Most owners do not buy cash, they use heavy leverage and bank loans. Because of this high initial debt, the horizon for profitability is long. A new hotel often takes years just to break even on its initial capital investment. Your capital budget splits into two main areas: physical construction and what the industry calls FF&E. FF&E stands for furniture, fixtures, and equipment, everything that is not nailed down inside the rooms. These items wear out fast and must be replaced every few years to keep guests happy. To fund this, smart owners set aside 4 to 5% of total revenue every single month into a dedicated reserve fund. This introduces a unique dynamic, the separation of the property owner from the business operator. Often, the person who owns the brick-and-mortar building is not the one running the daily check-ins and room service. Owners frequently pay big international brands for the right to use their name, reservation systems, and loyalty programs. These franchise fees typically eat up 4 to 8% of your room revenues right off the top. But in exchange, you gain instant access to millions of global travelers. The central economic choice for an owner is whether the brand brings in enough premium traffic to justify its high cost. Going independent means zero franchise fees, but it leaves you entirely responsible for your own marketing. The economics also vary drastically by asset class. Building an economy roadside motel costs a fraction of building a 5-star luxury resort. Luxury properties require much higher investment per square foot, targeting high-spending travelers. Select service hotels cut out the fancy amenities to optimize construction efficiency. No matter what asset type, once the doors open, you enter the highly volatile world of daily operations and fluctuating demand. Unlike manufacturing, hotel rooms are a highly perishable inventory. If a room stays empty tonight, that revenue is gone forever. This brings us to the first major metric, occupancy rate. It measures the percentage of available rooms filled on any given night. The second core metric is ADR, or average daily rate. This tells you the average price paid for the rooms that were actually rented. Multiply occupancy by ADR and you get RevPAR, revenue per available room. This is the gold standard metric for measuring health across the hotel industry. RevPAR allows owners to compare their performance directly against competitors, regardless of the hotel's physical size. To maximize RevPAR, hotels use sophisticated dynamic pricing algorithms that change rates in real time. Rates surge during high demand periods like weekends, holidays, or major conventions, and drop drastically during the slow season. This practice is called revenue management, selling the right room to the right guest at the right price. It is identical to how airlines price their seats based on demand and booking speed. While rooms bring in the highest margins, full-service hotels rely heavily on secondary revenue streams, like food, drinks, and event spaces. Food and beverage can account for up to 40% of a large hotel's total incoming revenue. Because of these extra spend items, owners also track TRevPAR, total revenue per available room, to see the big picture. Every hotel judges its metrics against a local comp set, a hand-picked group of 5 or 6 direct competitors. If your market penetration index is over 100, it means you are capturing more than your fair share of local travelers. Falling below 100 means your competitors are out-marketing or outpricing you. But pulling in guests gets complicated due to online travel agencies, or OTAs, which dominate web searches. OTAs provide massive exposure, but they charge hefty commissions, often taking 15 to 25% of the room rate. This is why hotels fight hard for direct bookings through loyalty perks and lowest price guarantees on their own websites. Tracking net RevPAR helps owners calculate what they actually keep after paying those commissions. Capturing revenue is half the battle. Next, we must examine the intense operational costs required to keep the building running. A hotel's cost structure is heavily weighted towards operating expenses, broken down into fixed and variable buckets. Fixed costs don't change whether your occupancy is 0 or 100%. You must pay property taxes, building insurance, and basic maintenance regardless. Variable costs, however, track your occupancy directly. More guests mean more laundry, cleaning supplies, utilities, and complimentary breakfasts. By far, the single largest operating expense in any hotel is labor. It frequently gobbles up 30 to 45% of total operating revenues. Managing shifts efficiently against daily occupancy shifts is the hardest part of managing hotel profitability. If occupancy drops unexpectedly, you still have to pay the scheduled front desk staff and housekeeping crew, destroying your margins. Utilities are another massive line item. Keeping massive buildings heated, cooled, and illuminated eats up 4 to 6% of revenue. Modern owners invest heavily in smart building systems that automatically cut climate control systems when a guest checks out. For full-service properties, food waste is another hidden drain on operations. Keeping the cost of goods sold, or COGS, for food and beverage between 25 and 30% requires rigorous portion and inventory controls. Skimping on building maintenance to save quick cash is a common dangerous trap for novice hotel owners. Deferred maintenance lowers the asset's core value and eventually forces sudden, expensive emergency closures. General and administrative costs, or G&A, cover essential corporate overhead, credit card processing fees, and hotel management software licenses. Regular compliance audits and safety checks add mandatory layers to your fixed administrative overhead. When you subtract all these direct operational costs from your total revenue, you arrive at gross operating profit, or GOP. It shows how efficiently the manager runs the venue. GOP-PAR takes this further by measuring gross operating profit per available room, giving owners a true picture of operational efficiency. A hotel can have amazing room rates, but if labor and food waste are out of control, its GOP-PAR will look terrible. Most operators earn higher incentive bonuses when they keep GOP margins above target levels. This means managing cash flow cycles is critical. Summer profits must be carefully preserved to cover fixed expenses during the lean winter months. Once GOP is calculated, we take the final step down the financial waterfall to see what the owner actually takes home. To understand true asset performance, owners look at EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA removes the distorting effects of local tax jurisdictions and specific financing arrangements, allowing investors to evaluate the core hotel engine. In a well-run, mature market hotel, a healthy EBITDA margin typically lands between 25 and 35% of gross revenue. From EBITDA, the owner pays down debt interest obligations and corporate income taxes. Non-cash expenses like depreciation are deducted here, offering valuable tax shields to real estate investors. What remains at the very bottom is the net operating income, or NOI. Investors use NOI to calculate the property's cap rate, or capitalization rate, which dictates its current market valuation. A lower cap rate implies lower investment risk and a much higher market sale price for the property. Ultimately, institutional hotel buyers focus heavily on the internal rate of return, or IRR, across a multi-year hold period. Real hotel wealth is built via this dual engine, collecting annual operational cash flow while banking on long-term property appreciation at final sale. However, this asset class carries elevated risk due to its acute sensitivity to macroeconomic downturns. A consumer figure cuts a link on a chain labeled discretionary spending. Vacation suitcase doodles fade away, leaving only bare minimum spending boxes. Unlike commercial office spaces with stable 10-year leases, a hotel releases its inventory every night. This makes hotel revenues highly volatile during unexpected market shocks. But this nightly repricing is a massive advantage. It acts as a perfect hedge against inflation, allowing owners to raise prices instantly as prices rise nationwide. Successful ownership requires a leadership team that masters both real estate investment and operational cost controls. A computer screen displays complex rows of real-time data streaming into clean operational efficiency charts. A check mark pops up. When these variable components align perfectly, the financial returns can significantly outperform traditional commercial real estate. It's a high-stakes, capital-intensive business, but the rewards are massive for those who execute flawlessly. At its core, successful hotel ownership boils down to balancing heavy fixed real estate investments with agile, data-driven daily operations. Master the metrics, control your operational costs, and you turn a simple building into a highly profitable, wealth-generating engine.